Thanks so much for tuning into Talking Point. I'm your host, Neelkanth Shah, and the Talking Point today are the views of Mr. Neelkanth Mishra of Credit Suisse. Needs no introduction. The only point is the context of this interaction, simply because there are so many issues, some of which might seem burning to the market at the current point of time. So it'll be difficult to categorize which is the most important thing to start off with. But Neelkanth, pleasure having you as always. Firstly, we hope all is safe with you and family.
Oh, all good. I hope the same with you, and thank you for having me on your show.
The pleasure is ours. Neelkanth, can I start off with something that is kind of front and center for the global markets at large, and maybe arguably for India as well, and that's geopolitics. How it's always been up there, but do you reckon that the current geopolitical situation, be it Taiwan, be it Ukraine, or be it what's happened in India in the last 48 hours, might impact the sentiment of the market in some way?
I don't. No, I don't think so. I think, see, if you look back the last 20 years or 30 years, there's always something or the other which is on the horizon, right? Sometimes it could be the Houthi rebels in Yemen. It could be something happening in Iran, something happening in Eastern Europe, something happening in the Crimea. The markets, start becoming choppy and worry when there is meaningful uncertainty over the next 12-24 months, right? So if there is something that gets resolved in the next week or so, and economic momentum gets disrupted, like what we saw in March 2020, when it was unclear how long the lockdowns would last. So those are things that disrupt markets and economies. Some skirmishes are, I think, quite natural, and we will not have a time, I think, in the next 5-10 years when none of these things are on the radar.
Got it. So then let's try and juxtapose. How do you see the economic growth and the actions from both the government and the Reserve Bank versus what is corporate India doing right now, and how would that impact? So you've heard the Reserve Bank of India. I presume when I looked at your estimates for how growth could be, you are in a manner of speaking materially higher than what some of the not so bullish estimates are about growth. Can you put this into context?
Yeah, so we expect significant upgrades to GDP forecasts, not just for FY23, where I think the numbers need to be bumped up quite meaningfully, because the economy, as it bounces, it can bounce much higher than is currently being forecast, and but also the growth rates that come after that. So once the base has normalized, will we grow at 5.5% or 6.5%, 7%? And we are in the latter camp. We think that the sustained growth rates will be higher. There are many drivers of that, right? So the first is, or the first part is just observation. So mobility-based nowcast of GDP is already 9% higher than the second quarter average, right? And the second quarter was around 0.3% higher than September 19, which is September 21 was 0.3% higher than September 19. And we think that the numbers, therefore, on a year-on-year basis, even the 9.5% growth for FY22 needs to be bumped up quite meaningfully. And on top of that, FY23, the growth momentum should build up from where we are, because jobs can come back in auto manufacturing. There's a lot of construction-related work, which I think should restart, not just state government Capex, but also dwellings construction. So far, the real estate boom is only visible in houses changing hands. That doesn't add to GDP, but it's when construction starts that picks up. There is a lot of normalization that is yet to happen in all people coming back to office, right? Many of the interactions, even today, that I'm having are from people working from home. We are working like 2 days from office, right? In a week. So I think that normalization will mean that you need more people, like the dabbawalas, the domestic help, the car drivers. So a lot of these jobs yet need to come back, and as they come back, the GDP growth goes up even further.
Maybe I'm mistaken, Neelkanth, but I remember reading a note, arguably from you, talking about how, despite these higher growth numbers that come in for the GDP, what it does to the earnings growth for the indices is one thing, and what therefore the valuations show about how expensive or cheap the market is yet quite another. Can you talk a bit about that?
Sure, yeah. So we have been talking a lot about that in the last several years, that the GDP and Nifty earnings are not that correlated, right? Because there's a lot of global exposure in the Nifty, plus there are market share changes, etc. So coming to Nifty earnings, right? So one thing is that even if GDP growth estimates get bumped up, it is not necessary that this will show up in the Nifty. For example, in between FY12 and 19, the GDP growth in real terms was close to 7% CAGR. In nominal terms, 12-13%, but Nifty EPS grew at 4% CAGR. Right, so there can be periods where you have a significant GDP acceleration, but nothing happens in Nifty, and so therefore it's very educative to look at what happened in that period. And so we demonstrate in our report that the growth slowdown in earnings was almost across the sectors. The financial sector was going through a balance sheet cleanup. So in financial earnings, as you know, there can be quite a bit of time shifting. So when you issue a loan, you book the gains, or rather book the interest as income in that year. The loan may go bad 3-5 years later, and that's when you write it down. And so it's kind of a time shifting of earnings, right? And that was happening in the banking system. So in FY18, 100% of pre-provision operating profits were written off as provisions, and that number is now coming off. It was 26% last quarter, September 21. For the next 2 years, the numbers are 31 and 29, the FY23 and 24. And I think that so that shows why the PPOP growth is now reflected in earnings. Same with global generics, right? So pharma, because there was oversupply, there was a period of surge, and then a very steep decline in the earnings trajectory. We had a big problem in telecom. We had a big problem in real estate. So a lot of the NBFCs got into trouble, and many of those cycles are now starting to turn. So we discussed the banks. We also think that dwelling construction is expected to come back. We should see what was a 1.1 percentage point of GDP drag on growth for every year between FY12 and 20 would be adding 20 to 80 basis points of growth between FY23 and 26. So that's turning. We are seeing some price hikes in telecom. We are seeing a lot of formalization related gains. So there is quite a bit happening, which makes us comfortable that the earnings growth that consensus is projecting of 15% CAGR FY19 to 24 actually is credible, sustainable, and FY24 EPS may even get upgraded by a bit.
So you foresee, or let's put it this way, for lack of a better word, you are in the more bullish camp, both on the GDP growth and the earnings growth for the indices. Never mind the fact that there is this scare of, the commodity prices being higher, energy prices being higher. I do remember reading your presentation or listening to you, and your belief seems to be that energy prices also will come off. But what about the commodity complex hitting earnings back?
Great question. So see, you cannot grow without using dense forms of energy, right? So productivity means, so if you're cooking your food on firewood, it can take you 2 hours. If you do that on a cooking gas or electric stove, it takes half an hour, right? So and that plays out for transportation, for materials, like so if you make a unbaked brick house, it can wash away very quickly. The moment you bake a brick, like we are still discovering Harappa bricks 5,000 years later, right? But you need energy for that, and we import 40-45% of our energy. So what happens when energy prices globally go up? It becomes a headwind to growth. So it's not just that we are now paying a lot more. So basically, see, if any commodity goes up, I mean, it's a gain for some. If it's the domestic supplier, someone benefits, someone loses, so it kind of evens out. But when you pay a lot more for imported energy, you are throwing money out. More importantly, if say fuel becomes so expensive that you do not want to travel from point A to point B because you say it's going to be too costly, so that slows you down. That slows the economy down. So that is a headwind to growth. And I think some of the November slowdown that a number of sectors have talked about was, I think, also triggered by that. Now, since then, of course, the government has tried to absorb at least half of that headwind. So our estimate is that the rise in crude oil, gas, coal, fertilizer, edible oil, all of this together added about $40-45 billion annualized to our import bill. And almost all of that got passed on to the consumer. That is a headwind to growth. Government's interventions, state and center together on fuel taxes, was about $20 billion. So half of that absorbed. And since then, of course, oil prices have come off, gas prices are coming off. So the question is, will this persist, right? Will we see $70 oil or $75 oil for all of the next 12 months? I'm definitely not in the $90, $100 camp because I don't think the global demand is strong enough. 6% of global oil consumption is for international air travel. And given what is happening on, forget the Omicron variant, even the Delta variant, I mean, there's so many countries that are still struggling with deaths per million being elevated because of the Delta variant, that total opening up, a complete restriction, complete easing of restrictions is something that may not happen. Look at even what's been announced in China, for example, right? So for the Chinese New Year, in Shanghai, large gatherings are discouraged. Now, compare that to India, where we are at least now starting to see even restrictions for marriages start to ease, right? Where, I've seen marriages where perhaps 100 were permitted or 300 were there.
Yeah.
The point is that, so therefore, I don't think the environment is right, at least on the demand side, for oil to see that kind of a surge. If oil goes there, then I think the global economy slows down even further because the ability to pay for that oil is not there. And therefore, I don't think that energy cost will become a permanent headwind for growth.
Supply side issues notwithstanding.
So supply side is definitely an issue. So meaning that, and this holds true for overall inflation as well, that, pre-lockdown, pre-COVID, demand and supply were here, somewhere, wobbling around. And then COVID brought them down here. Then stimulus brought demand here, and now you have to bring supply back, right? And in every sector, or let's say in every sector which was badly impacted by COVID restrictions, there is a marginal supplier who has not had business for 18 months. And that supplier is now being told you come back. And he says, well, at $70, I am not coming back. So because I'm unsure that, I'll come back and then suddenly prices tank again. So you need to give a higher price signal. But once the supply comes back, then prices normalize. This is what's happening in steel, for example. Of course, there's a demand issue in China too, but the bullwhip effect is easing because supply and inventory levels went up. So I think the supply response is happening. You're seeing that in gas and oil. The question, of course, is that like US shale. Is there enough of because there are estimates that it could be 1.5 million barrels a day lower on a sustained basis. And so if demand was to go back to normal pre-COVID and then go up a bit from there, then we may not have enough supply. But it's also the ability to pay. See, the global end demand even today is very weak. So if prices go up that much, you see the US president starting an investigation for collusion by energy companies to keep, which means that it's hurting, right? It is hurting the common man. And that itself is a natural cap on how much oil demand can be there. So I'm not, because I'm worried about global demand in general. I don't worry too much about global energy prices.
Okay, fair call. So let's assume that that's how the situation plays out, Neelkanth. How conducive is it, therefore, to buy into Indian equities at a point of time when we've had a really good run, despite the fall that we've had recently, and maybe including your house, but so many global houses have spoken about how India may not necessarily be the best bet going into 2022. Maybe China is, maybe some of the other better valued markets might be better bets. How do you then talk about, or what's your view, therefore, into how one should play Indian equities?
So some of those houses have been bearish for a while. So we were quite constructive. In fact, our global strategist was extremely overweight India. It's only now in this 2022 outlook that is gone to a mild overweight. In our regional strategy, we downgraded China in February. We upgraded India meaningfully, and April onwards we've caught on to the rally. But now, so from September onwards, given that we were at 2 standard deviations above the 10-year average in terms of forward price to earnings, and even if you built in 10% EPS upgrades to 23 and 24, you still had very high price to earnings 1 year later. So we said was both okay. I mean, now that this is we are very, very constructive on medium-term outlook, but this is pricing in too much too early. With this 5% correction, I think some of that room has been created again. And if we see FY24 EPS getting upgraded again, so in our regional strategy, we are still overweight, but that I think is mostly because we are worried a lot more about other Asian markets than we are about India, and therefore, I mean, I think the Nifty as a whole may stay range bound, maybe 5-7% here or there, but within the Nifty, we see a lot of opportunity in the domestic cyclicals, which adjusted for the kind of price to earnings or rather the earnings upgrades or earnings growth that we see going forward are going to still be, I mean, they still look reasonable. And therefore, on financials, industrials, cement, even staples, right? So staples people think are not really a domestic cyclical. The reason we are including that and we are overweight that sector is that the last 2.5-3 crore jobs that have not come back are mostly low-income jobs. And when those incomes come back, there will be a boost to demand. In all of the listed space, it's only staples and telecom, which is actually has the deeper the penetration, which is deep enough to get into those kind of income segments. And therefore, we think that the staples also deserves to be an overweight. We are underweight, and that reflects at least my concern on what's happening to what is the likely changes to global growth going forward. So we are underweight global cyclical. So IT, metals, energy, and some of the global auto names which are listed in India.
Okay, interesting. What about some of the other newer themes that have gotten formed, Neelkanth, in the last 18 to 24 months? Now, I wouldn't bucket chemicals out there. I'll leave that out. We'll talk about that later. I'll have 3 more questions, Neelkanth. I hope you have the time for that. First, this whole creation of this PLI beneficiaries, which have really taken center stage in terms of manufacturing, at least the mobile appliances have, and some of the others are coming to the fore. What's your sense there? Do you think, aided by the government moves, there is merit in trying to looking at the long-term story there?
Yes, there is. In the listed space, it's harder to find direct beneficiaries, right? So in all of the sectors that we have seen action on, there are a few where traction has been limited, right? So like apparel, even the autos had to be changed to electric vehicles, and we're yet to see how that actually transpires. And like even medical equipment, some of the network equipment. So some of those PLI schemes, I think, are not, I wouldn't say struggling, but not that exciting. On the ones that are doing well, like say handsets, or even the other electronics, like tablets and notebooks, where the applications will be strong, food processing. The number of listed companies that that can benefit, where exactly it's too small, and even where there is exposure, the percentage impact on earnings is actually quite insignificant. So while it is, I think, fantastic from an economy perspective, and as a policy measure. So when we wrote on PLIs in December last year, and this was still sort of cooking. It was mostly, I mean, we wrote that a pro-growth turn in policy, that it was a sign that the government was willing to work with the private sector to drive India's export competitiveness and therefore create jobs and grow the economy. And so that principle, I think, still stays there. So if growth in general is the government's priority, if very wisely the government wants to adjust the debt to GDP by growing the denominator, or sorry, to reduce the debt to GDP by growing the denominator, then the best way to play that is through the domestic cyclicals. So that's the thing. But yeah, PLIs in general, I think, are a good step. It is to be expected that they will work for some sectors and they will not work for some sectors.
Fair call. Actually, just stretching that point a little bit, Neelkanth, there's some analysis that we were doing internally, and you would have a better insight here, which is I'm asking you, that at the times of a good cycle, the Capex related themes in India, 2000 to 2010, did really, really well. Both ROEs, margins, etc., expanded, all of which contracted. And now, if we are at the throes of yet another Capex cycle, if you believe so, would all themes related to that play be structural bullish themes? Because not only will valuations expand, but the earnings growth also will be fairly strong, consistent. Is there merit to this argument?
Yes, there absolutely is. I would only temper it down a bit. So there is this temptation that, oh, this is a repeat of the 2003 to 8 cycle. It is not, right? There are similarities, but it's like the deja vu dream, right? It's not the same, right? So and the big difference is global growth. So in 2003 to 8 was a synchronized global recovery. The US real estate, well, let's say the North Atlantic real estate market was booming. Financial firms were adding on leverage like there was no tomorrow. Every global bank was at 30 to 40 times assets to equity. And that as that leverage built up, of course, there was a lot of risk taking and a lot of growth. And China had been growing at 10% for 25 years, but it had now become of a certain size where it was adding 10, 15, 20, 30 basis point of percent of incremental GDP for the world. The next 5 years, if I was to draw the parallels, at least that growth acceleration is no longer there. It is unlikely that global financials will add on that much leverage. But when it comes to domestic cyclicals, meaning that domestic investment, so it is unlikely that metals Capex. So there was a time in 2009-10, and I used to be a metals analyst then, that India's capacity was 45-50, and we were adding 60 million tons of capacity. India's power capacity was whatever 120, 130 gigawatts in thermal power, and you were adding another 130 gigawatts of capacity. Those are things which I think are unlikely to happen. Right. So what you will see is a lot of supply chain work in autos, in electric vehicles, in electronics, in construction materials, which is likely to happen. But it will not be that rara Capex period that we saw in that.
Okay, our final question, but I must commend you, Neelkanth. I remember a conversation, I think early this year, when you said keep an eye out on China, and you were amongst the earlier ones to start to turn a bit worried about the valuations that the metal companies were trading at. I think the last 3 months have shown the proof of that caution. I'm presuming you've not turned constructive, so I'm not asking you that question. Or have you?
No, we are not. So we are very bearish. In fact, I would say that the last time Chinese real estate prices fell like they have done now, steel prices went to $300. Now, I'm not saying that they're going to $300 again, but we have seen nothing of the down cycle yet.
Got it. My final question, Neelkanth, and that is on IT. Hitherto, in the last few years, if you will, at least the last few quarters, if not years, most people who called a top on IT have thus far not proven to be right. And I hear managements, they are talking about growth visibility for the next 2 or 3 years. So is it the valuations that compel you to not be bullish on IT, or is it something else?
Yeah. So we downgraded early. I mean, I'll accept that. And even on metals, we downgraded end of May. We should have waited till end of July. But the thing is, so on IT, it is valuations. It is also that while there is no denying that that the global growth in software is super strong, right? Every year the demand for software and writing code goes up, and there are no people. I mean, there are lots of people, and people will be reskilled, but no place other than India where you can get engineers in bulk. There are 3 million engineers potentially who can be retrained. But who will provide that? Will it be the offshore center of a global IT major? Will it be a software as a service company, whether it is Indian or global, which is a very large setup in India? Will it be the Indian IT firms or Indian technology firms or Indian corporations which need to invest a lot more in IT? So when you start going through that, you realize that the top 10-15% technically proficient people in these firms, the Indian IT firms, are going to be poached by people whose potential revenue per individual is many times that of the IT firms, right? For example, a SaaS company, even based in India, can earn revenues which are better than on-site revenues for the Indian IT firms, and therefore the attrition levels, the wage hikes, and how much of it can you sort of show up in, or can you get in terms of repricing? So repricing has started. So to be honest, I mean, we hear that customers, clients are willing to reprice because they also need people. They need a lot of work to be done. But can you totally offset that? Can you handle the levels of attrition without hurting your ability to deliver on projects? And so as we think of all of that and we see the valuations, we tend to get a bit cautious that, look, this growth, and the truth is that if they don't grow at 8%, they'll grow at 10%, maybe at 12%, right? They're not going to grow at 20%. And therefore, while there is a fair amount of sustainability in their growth, and I agree that there's at least a 2-3 year window, but I think that we can see 20%, 15% growth in several other sectors, and I would rather be there.
Yeah, and maybe the earnings growth might be a bit lower than revenue growth any which ways. So yeah.
Yes, absolutely.
Awesome. Neelkanth, thank you so much. It's always amazing talking to you. Today is no different. Thank you for taking the time out, and have a great year end.
You too. Thanks.
And viewers, thanks for tuning in.